Please. We will constitute our panel now. I request Tapan Sharma from SBI to please join us. I also request Jyoti Prakash Gadia from Resurgent to join us, and Amit Goenka. Amit Goenka. So he'll join us in a minute. So, yeah. Thank you. Good afternoon, everybody. We are on the good evening stage. Hope all have energy. See, we are trying to address a very important problem to make real estate projects as bankable as possible. So, in this direction, we have kind of different representative groups. The representation from SBI, we have the product development in charge, Mr. Tapan Sharma, with us. Welcome to you, sir. Yeah, and from the market perspective, we have got a lot of experience interacting between banks and builders. We have Resurgent India, Jyoti Prakash Gadia. Welcome to you, Jyoti ji. And as you have heard from Pooja Malani, so she represents ENY, Ernst & Young. And this particular panel, we are trying to derive some kind of understanding, trying to evolve some banking product which will actually address the requirements of real estate industry. One of the important observation that I've made is, if you consider small, medium versus Cat-A builders, 90% of the small and medium projects are not being funded through banks. And if you compare between Tier 2 and Tier 3 cities versus metros, 50–60% of the Tier 2, Tier 3 cities projects are not being funded. Only metros are preferred. And what if somebody wants to develop once in a lifetime project? If they want to do only one project, which means the promoter is going to develop only one thing, so he will not have any kind of vintage. 90% it will not be funded, 90 or 99. So only career builders are bankable. Is that correct? If that is the, my question is that Dubai would not be built by the king. He is not a builder. Now, there are fully funded projects versus JV projects, fully landed projects. See, there are so many people who are having lands on their own, but those kind of projects are not being funded. Only JV projects are somewhat, as a tradition, it is being accepted and they are funded. Presently, the market, the funding happens at 30% promoters contribution and 35% from sales, and then another 35% from the banking. Versus, what if 70% of the required amount, other than the 30% promoters contribution, comes entirely through bank? Banks are not funding. In fact, we will have a deliberation on that as well. Full cycle funding versus part funding. The full cycle of completion, till completion, why is it not being funded? So that also we shall look into. Only part funding happens. So Amit Goenka is there. I request you to please join us here. Mr. Goyal from SBI Capital. Amit Goenka is a seasoned fund house expert and from NISUS. So another colleague of Irfan Kaziji, he's a PIO of Swami Fund. Welcome, Mr. Goyal. Now we are having all the alternatives of, alternative solutions here. Now we have to analyze which one will suit us. So the questions, whatever we are asking, shall be answered either today or in the days to come. So as I was referring to term funding versus working capital funding, working capital funding is not available for real estate. The traditional funding, whatever one particular product is there, the other innovative fundings, very few innovative funding is available. In total, if you compare, I think almost maybe less than 5% of the projects are bankable. So this is a big statement. I don't think anybody will, kind of object to that. And this is actually, the bigger opportunity is that 95% of the projects are available for funding and improvement. So that is where we start today's discussions. Now, my first question to our senior banking Mr. Tapan Sharma, what is your opinion of traditional banks, SBI being the senior most bank, and what is the process to create a new product, being an expert from product creation?
Yeah, thank you so much. In fact, at the outset, if you talk about the real estate funding and from the lender's point of view, of late, since the introduction of RERA, the bank's approach towards funding of RERA has undergone a sea change. Means banks no more look it as something which I was listening that banks are shying away from funding the real estate industry. We as a SBI, we don't believe into this. In fact, yes, the kind of funding at times the real estate projects require, the product evolution or the product evolvement, might not have happened in the last 4 or 5 years post-RERA. Because with the introduction of RERA, the industry is regulated, the margin of the promoters, the details of expenses, everything is now being controlled, moving through escrow. So that is was the comfort the bank has derived, which is even better than the manufacturing industry. So the banks, as of now, normally we fund it as a project, as you correctly said, that the promoter's margin. One thing I would like to clear here, it's not that banks are not funding the land. Banks cannot fund the land on a standalone basis because the RBI doesn't permit, but the land which is a part of the project, for any project which is upcoming there, that can be taken as a part of the project cost and can be even treated as a margin of the promoters. But yes, we have a cap over that. We don't take land as a margin more than 30%. And similarly, the another part of the means of finance which comes in the form of bank loan as well as the receipt. Receipt means the booking amount, which also we restrict to 30%, 50%. So 50% of that. Now the problem arises when the banks, as a banker, we ask that the land should be fully paid and the land cost is higher. So initially the margin of the promoter becomes very crucial to brought in upfront. Working capital can be a very good solution. As of now also the banks are funding in the form of working capital, but that is restricted only up to 3 years. Any loan which can be liquidated within 3 years can be funded in the form of working capital where the developer will have a flexibility of availing as and when required. But as the presentation made, the working capital for a longer period can also be explored. There are few things which we need to approach to the Reserve Bank also, because the working capital can be sanctioned only for 1 year, as we know in the manufacturing industry as well. Every year we need to reassess the limit, and that is payable on demand. So in this case, I am committing for a longer period, since it is a project. I cannot after 1 year say, okay, means I am not going ahead with this limit. What happens if I reduce the limit? So those parts may not exactly fit into as a manufacturing unit, because manufacturing unit, the term finance is done for the project implementation, and thereafter it's purely on the working capital cycle. Here it's only one cycle. It's not a multiple cycles. It's only one cycle. The developer will develop, he will construct and sell it. So this is only one cycle in this, involving in this aspect. But having said that, the assessment and evaluation of the real estate funding post-RERA, the bank is becoming very, very open, and there are different methods for the residential as well as the commercial real estate. We have some other products, but for the period where we do not see that whether the booking amount or whatever the cash flow which is expected, which will come or not, 70% loan funding and 30%, 35, 40% promoter contribution, if it can come, the bank will be very comfortable, knowing to the fact that this is the only industry, if I compare with the capital goods or manufacturing, wherein once we land it for the project, after 2 years, 3 years, the machinery cost and everything, it gets absolute end, the valuation goes down for the bank. The project cost goes down. Wherever in this industry, as the time passes, the valuation improves. So bank's comfort goes up. This is a very peculiar thing which, as a banker, we realized, and we are looking into that aspect, that this industry, the loan will go down and the valuation of the project or the security of the bank will go up. So accordingly, the bank, with the suggestion, is very open to work out something, if not exactly the working capital, but something of the bridge or some product wherein reassessment the limit after 3 years or 1 year. Because in working capital, we have the stock statement every month. We know what is the stock available, what is the creditors and all that. Here, it may not be possible for the bank to reduce the DP in between the project. So that is one aspect we need to work on it. But yes, definitely being a traditional banker, a state bank, but as a lender, as a group of lenders, the bank is very, very comfortable comparatively to earlier years with the real estate, barring the COVID situations and all that which affected the entire industry, not only the real estate industry. But by and large, the opinion towards funding the real estate industry is very, very positive from the banker's point of view. Thanks.
So very well put there. So one, that traditional banking product, though it has got limitations, and one of the important limitations that we are having is through the RBI blockage of 1 year cycle. I think, see, this is where industry body and financial body, this particular platform can influence the government, and maybe if there is an exception made to only real estate industry to look into the cycle of say 3 years or 4 years, then for real estate only, then it can work. Actually, if I am not wrong, the similar industry is automobile industry versus shipbuilding and airline industry. They are all getting funded, if I'm not wrong. So we also can look into such different aspects, and maybe with a proper representation, we will be able to do that. See, SBI, though it is a traditional bank coming under RBI, it has backed a fund, SBI Cap Fund, and that particular SBI Cap Fund is coming under SEBI, which has got its own separate mandates. Whatever that mandate today, it might be, some of them are blocking the 100% expansion of it. Even then, a good attempt is made. The instrument or the methodology is actually very, very comfortable. I would like to ask Rajatji about what is your experience and what are the limitations in extension to what Irfan Kazi just told in his presentation. How well we can maybe circumvent certain issues and increase the horizon of funding for real estate.
Thank you for having me here. So I think today the banking or the financing solution needs a theme-based funding. So if I look at Swami is found with an objective to fund stressed or stalled projects. There are similar themes like green financing, there are similar themes can be affordable housing. So I think the theme-based funding is, I think, what one should focus on. So under the Swami, so let's say, when I say about theme-based funding, what I mean is that as an institution, when we fund that theme, we should be true to its spirit. At Swami, when we fund our stress projects, we believe that when we fund a stress project, it is not supposed to just give us an IRR back. The project should come out of stress by our funding. So it's a dual purpose we solve it. We fund to provide an objective of end game, which is achieving the full completion of the project, home buyers getting their houses delivered, and then we believe that our funding can come back to us. So that's that's the focus on the theme we have. A typical lender, typical lender where we have been looking at, if you go back in history, is more focused on their own returns rather than focusing on the objective for which that funding has been given. So that's where I feel. So as long as we keep having that objective and we keep having those theme-based theme-based fundings, we should be able to widen the horizon. With regard to Swami's concern, as Irfan mentioned in his presentation, it was formed with a defined objective of stress projects in affordable mid-income segment, which is defined by the definition of 2 crore, 1.5 crore, 1 crore limitation. So we are limited by that approach. Unless, it doesn't stop any other institution in the country to maybe launch a fund which solves other issues which are existing in the real estate industry. You can launch a product for, luxury products. You can launch a product for a green financing. Swami has done, without mincing words, I think he has done a great job in making the dent in the industry and being a catalyst to revive the industry in a formal manner. We do see a capital formation happening, not only by building houses, but the cement players, the steel manufacturers, the houses, the roads, the infrastructure, around the whole vicinity comes up the moment a particular real estate project comes up in that industry. So that way, Swami's done well. I think, as long as we keep doing this kind of work, I think real estate industry will not have that issue.
So very well put there. I think with all my appreciation to the Swami Fund, I would, my wishful thinking is that all banks start their own funds, very specific to the industry, and there are some good positive lessons from Swami Fund. With that experience, every other bank can start their own fund, every other fund house can start their fund, and then fund the real estate. I think that's more of a wishful thinking. Poojaji, I think you will accept all these statements. If you have any more to add, just a sec.
So I think, no, I completely agree. And hello, yeah. No, so I completely agree with this, and I think it's good to hear from SBI that it's a product that is worth thinking about. And of course, a variation of this, and certain issues need ironing. But I think it's good if it at least has an acceptance.
Yeah, our Jyoti Prakash Gadia actually deals on the ground, and he sees both sides of the coin. We developers might be cribbing that we are not getting funding, and he also will listen to the bankers that so many builders are getting into default situation. So with a neutrality of situation, you can just explain whether going for new product is an essential one, or should we stick on to whatever we are doing now?
Thank you, sir. And I will just wear a consultant hat, because that's why the client comes to us and he asks us, sir, how can you raise bank funding for us? So if we cannot bring and we cannot do some innovation, then client definitely will not come to us. Today I will explain you 7 ways through which you can raise the bank funding. First way that we are going to discuss, it is about the MSME definition के अंदर में कैसे आप पैसा ले सकते हैं. How you can classify your project under the MSME definition and you can take the project. In some of the banks, they have classified real estate project as an MSME project where the project cost is less than 125 crores and the funding requirement is around 50 crores. So this is where they classify this project as an MSME project, that real estate project, or some banks, they have also classified that where the entire project is within 100 crores of. So I think so in case if we can only work with the bank and tell them ki sir, if you the real estate project only can classify as per the MSME norms of the country where 250 crores of top line and requirement of 50 crore whatever that is there, I think so our requirement can be satisfied till time every bank is making their own norms that how we should classify the real estate project as an MSME definition project. So this is one way that we can raise money with. The second way that you can also approach a banker for raising money where you can club 2 or 3 projects of your own, because what is happening under RERA is this, is that 70% of your money, you have to use this money under the construction cost. So bank is asking you ki what is the peak level deficit that you are having in this next 3 years of time frame. So in this next 3 years of deficit, it is difficult to project because every time you are doing slab 1 construction or you are doing some construction link, the funding is coming in. So there is, though the cash flow difference is not coming in. So what we are telling to a banker, you are just clubbing 2 or 3 projects together. Then you are telling ki sir, you either in these 3 SPVs, you make common borrower or you make all the 3 projects at one borrower. And then you combine the cash flow and tell to a banker, I require an OD limit because it is not necessary that customer advances whatever I am projected, out of which only 60 to 70% will come in time. So there is a gap of 20 to 30% of the customer advance, which may not come in time. So combining with 2 or 3 projects together, the customer advances, then the deficit becomes little bigger for the banker to come and fund the project. So this is the second way through which you can raise the bank funding. Third, you can always tell bank that since we are talking about it, there is always a cash budget system in a working capital arrangement. There are 2 types of arrangement through which the bank can give money. One is through what we call as an MPBF type of a funding, which Pooja ma'am has definitely explained to you. The second way of funding, which we call as a cash budgeting methodology, where all the contractors are getting payment. In the cash budgeting methodology, you are including, like in the month of January, if you want to make the drawing power for the month of February, since there is no stock, nothing like that, you only have to give them what is the expenditure that you are going to incur in this next month and what is the inflow that you are expecting. So whatever is the deficit between the inflow and the inflow and the outflow, that deficit of that 75% of that deficit will be treated as the drawing power for the next month. So that's on the cash budgeting methodology, through which we also call it as a cash budget methodology. And then to give the another comfort, we can tell to a banker that you can also make it as a drop line OD limit, where we are telling the banker, if you are taking into a 4-year loan, for the first 2 years there will be no limit reduction. From the 25th month onwards, whatever is the repayment period, it will be in the form of a drop line OD, it will be in the form of a cash budgeting, but from the 25th month onward, my overall term loan amount or my OD limit will start getting decreasing. But the interest will be paid only on the amount that you have utilized only for that particular month. This is the third methodology through which any developer can get bank funding. Fourth methodology is where customer, developer and the banker combined, and then they create a structure which we earlier used to call as which we used to termed as a subvention scheme. In this subvention scheme, since it is not happening, but there are many affordable housing schemes, where in the affordable housing scheme where the government is auctioning and government is giving, like in Haryana. So all the projects or the customer are readily identified that who would be my customer. So we are approaching the bank, sir, he is my ultimate beneficiary or he is my ultimate customer for the flat. You are already known because the government has already told them कि उसको lottery करके निकाल के बता दिया कि this particular guy is going to be your customer for that particular flat. Now that customer file is already there with you. Now with that customer file along with, and the bank knows that how much is the customer eligibility at that point of time, and he is going to get that flat there. So with the customer giving him an undertaking, only thing is that interest need to be charged to the project, not to the customer. So banker exactly knows that there is a sale which has already happened there, and there is a customer which is already there, and this is how this entire, which we call as under this tripartite scheme, this also is a very, very good scheme through which also you can get the project funded. Fifth scheme, which we also call it, that there is a lot of approvals which is required, and in the towns like Bombay, where the approvals come in the mid of a project. There are some approvals where you are getting mid-size of a project. So now, what is the innovation that you can do in a sanction letter is that you can always term the bank's as sanction letter. You should not mention the particular date of disbursement. You should always mention that after this approval is come, 2 months after the approval date, 3 months after this approval date. So that what happens is that because in 90 days the loan has to be get repaid, or there is an NPA norms, but the flexibility in the sanction letter itself we can start drafting, so that instead of putting a rigidity date, you can always put that these are some of the milestones through which my disbursement can get delayed or my project can get delayed. Based on that, you can always say 3 months based on this, 2 months based on that, and that is also banks are accepting the sanction letter like that. But the overall tenure of the loan will remain 5 years or for 4 years, whatever that we mention about. Lastly, there are 2 types of things which the bankers told that the land is not getting funded. There are 2 types of land funding which bankers are definitely doing. So sorry, Tapan sir, just for the recap of the thing, in case if the land is auctioned by the government, auction at the time of the auction of the government, in case if there is the entire project cost, that time the banks is also funding 60%, 70%, depending upon your creditability and other thing, that direct payment is going to the government. If you can prove to the banker, that time it is happening. The land purchasing is happening in the form of TDI, where in the first instance you have purchased the land, their bank is not funding. But in case if there is an increase in the FSI, and then you need to purchase the TDI, at that time it is included in the project cost, and that time the banks are for funding that TDI cost increment, whatever that you are talking about. Lastly, sir, in terms of the working capital financing, the easiest way to get it is through a bill discounting limit, where you can get your supplier bill discounting. So these are the 7 methodologies, I think. So in case if we can just innovatively apply, we can get the bank funding. Thank you, sir.
Thank you. Actually, that was a deep dive into the existing methodologies. Thank you, Jyoti-bhai. Now, as far as this full project funding goes, we have a product development expert with us. I request Tapan bhai to please give us a small brief on, okay, just before that, I would like to hear from Amit Goenka ji as to what are all the ways and means, because we are hearing the bank side only. Now, PE and NBFCs, what are the means to improve the funding policies and which will suit the real estate industry? In fact, they are funding for land purchases also, greenfield projects, last mile for the projects, everything they have done. With a vast experience, can you please tell us how to improve the situation with the different policy itself?
No, I think Rajat and Jyoti Prakash have largely covered most points, so I really don't know what extra you need me to talk about.
Is there a requirement for changing the banking policy?
No, I don't think so. I think whatever is happening is obviously to err on the side of conservatism. I don't think banks need to lose more depositors' money. So obviously they're being conservative, and rightly so. I mean, we have a very volatile environment, we have a high interest rate environment, and obviously people need to be cautious about it. So I don't think there's much requirement in terms of what the banks or the regulators need to do. I think there's enough capital being provided already through multiple sources. They've allowed now even cooperative banks to start lending for redevelopment projects. So I think gradually there's been a lot of opening up any which ways.
Okay, one is that full project funding is not happening. So I think as a product development expert, Tapanji can throw some light on that.
Yeah, as Mr. Jyoti has given all the existing ways of how the banks are funding. Obviously, yes, this is real estate is funded as a cash budget. If I go into details of the financing patterns and all that, this is something like a working capital only. Cash budget means your whatever expenses you have made, what are the inflows, the gap of that, up to 70% bank can fund you, 30% margin. So that's a basic, and every month you give the expenditure and inflow. For the next 3 months projections, we give the drawing power, accordingly it is disbursed. Even for the even if it is in the form of term loan. For example, I have given a loan for 6 years, 7 years also, we can go up to 6, 7 years, provided normally we are keeping the repayment to finish within 12 months from the end of the RERA. So 6 years we go and 12 months because it is expected that the booking should start and all that, and by that time 12 months it is repaid. As initially it was suggested during the opening remarks that another product like simply why the banks cannot exclude the booking or sales receipts and simply fund it like a project like 30% of the promoter equity, 70% of the bank loan. For example, if the booking receipts are better, so to that extent the loan can come down, loan roll will be lesser, and then the dependency on the booking receipt of the developer will come down. That is the one part which can be looked into. But from the lender's point of view, if you see, normally the bank looks for the risk part. And we assume that, unless it's a long project, we assume that once the project is launched, it is 34, coming up to the plinth level or something, there normally we see a reasonable amount of booking coming in. If the project is not having a booking in that gives a little bit of a risk perception in the lender's mind, then why the booking receipts are not coming in this project. And the moment the bank starts looking from the risk point of view, because ultimately the bank, the premium, the bank interest and everything is linked to the risk. You all would appreciate that. So even right now also when we fund, we take the booking receipt amount maximum normally 30% or with maximum 50%. Suppose because there are different types of projects which may have. The large value projects that will require a very different type of funding. They will involve initially the land payment itself will be so huge that we would not expect that all the builders will be able to make it upfront payment. But we talk about tier 2, tier 1 cities where somebody is coming with a reasonable 100 crore, 200 crore project size. He is bringing 20, 30 crores of equity land purchase, then this model will work. But for the larger projects where there are a lot of long gestation periods, where the big developers are involved, definitely we need to have a relook at the product, because these basic vanilla products may be suitable for a single one project being done by one promoter at one moment, so that the cash flow is coming directly to us. The entire funding, like as one more thing he has added, that FSI funding, whatever the approval cost and all that, that is all included in the project cost. So vanilla project, as for funding of the real estate, I don't know, means what will be the experience as a developer. The bank has a decent product. What the issues with the bank comes is when the land payment itself is the promoter is not able to make it, because it's a huge land payment initial level, and the bank would like at least the land should be in the name of the builder so that we have a charge over that, and then we can start the project funding. There comes the role of the some bridge funding or something mezzanine funding where some NBFC or can chip in and come for the purpose of funding the land for a particular period. And once that charge is created in the bank, that loan can be repaid through the bank funding itself. That also can be looked into. Working capital, yes, definitely working capital can be looked in for a longer period. But technically speaking, the funding of real estate itself, cash budget. Cash budget is also a way of funding a working capital. There can be, means he had given on the base of the project, the turnover, project is stock level. Another is the base on how much you are going to construct, what is your expected inflows in the next month, and what will be your gap, which can be funded. That is also just an assumption given by the builder. With our experience in the bank, means of the funding the real estate projects, we are of the belief that initial level the developer requires a lot of money, because at that time booking lot of funds goes into the land purchase plus the approval part, where the banks are normally not stepping into support. And after that, once the project goes on smoothly and all that, automatically the booking receipt itself comes very handsomely. So the bank, at many times we are observing that the real estate players are not able to draw the limit which the bank has sanctioned, because the booking receipts are coming in a very healthy manner. So if I take the deficit 70%, even after 30-40% of the booking receipt are coming, 30% in my contribution, what is the left out? 10-20%. So you will not be able to draw the entire limit. Wherever the project where the sales are not coming, what is estimated, because we have given a period into the RERA, that project will be completed in 5 years. I cannot go funding a project which is completed in 5 years, how long the bank will wait? So therefore, the working capital funding can be evolved, and as suggested, in between, if there is a joint of some equity funding from the bank for the purpose wherein the sales proceeds are not in line with the estimates. And one more thing, suppose we have given, I will just give you the example of one project has a period of construction of 5 years. They assume that 5 years we will, and RERA also they have given 5 years. We will give the funding accordingly, assume some cash flows, and it has to be repaid 5 years plus 1. So within 6 years it has to be paid. After 5 years, suppose it is extended. In the RERA, the construction extended. But as a lender, I cannot extend my repayment period there because the RBI doesn't allow that, and the loan has to be classified as restructured and has to be classified as substandard. So the bankers are that way are very bound by these things. Even if I give the working capital, then also I have to strict the terms which I am sanctioning at the moment. Yes, I can have the start of the disbursement and all that what he suggested depending on the approvals. That is only on the initial part. Once I start the disbursement, that has to be fully with the terms and conditions which are agreed. So at this forum, lot of things can be approached through the industry association to the Reserve Bank also to have some flexibility, because this is an industry which is highly dependent on the approvals, later part also, litigations which may come during the course of construction or the project implementation as well, and the booking amount. So one part, if the bankers are given the flexibility, this product can be evolved very easily because we have the comfort of having a very strong security, very strong collateral primary security available to the bank for this industry. Right. Thank you.
See, some important key takeaways for this is that the land, if it can be considered as promoter's contribution, then I think we can bring that land either in the way of SPV or in the way of equity, direct partnership with the landowners also. So with that security, we can kickstart the project where it is around 30-35% of the project cost. So I think as we were discussing earlier, we can use that as a leverage, and then we can start working on that.
Yeah, absolutely. That can be worked because 30% land portion if the promoters are bringing in, or if the landowner can become the part of the project or as a co-borrower something, then it becomes, we treat up to 30%, the land cost can be taken as the margin, and that takes care of the promoter margin. The later part, the bank can straightway start funding the project for whatever expenditure it happens later on.
Exactly.
Satish bhai, just a second. You had a question that how can a bank fund 70% of the project cost? Can I answer that question, sir? So there are two types of projects actually. Either there is a sale model or it is a leased out model. Like in case of a leased out model, what happens is that you are constructing the project first, then you are leasing the asset. Whatever is that thereafter you are telling to a banker that after the property is leased out, I will do an LRD amount with that, and thereafter I will repay the bank loan. So there what is happening, you are taking a 6-year loan or a 7-year loan where into the lease model. In the lease model, there is a 70-30 cost of project, there is a 70-30 model or 60-40 model, depending upon the lease rental, upon the completion of that asset and what is the potential of that LRD that can happen. Depending upon the LRD potential, my loan amount is determined right now. And depending upon that, whether the loan amount will be 60% or 70%, that I can decide it right now at this present moment. Because what we are telling to a banker is, sir, I am not selling even a single square feet of the property right now. I will complete the property, maybe it will take 3 years time. Thereafter, I will take 2 years to lease it out. And at the end of the 5th year, I will do an LRD and then I will repay the entire loan to you. So this can be one of the structure through which you can achieve your 70-30 structure. Thank you, sir.
No, even I would like to one more thing. Even in this structure also, if a developer is indecisive, maybe a portion of my project I will be selling outrightly, and maybe a portion of the project I will be giving on lease. That model also, and the bank has been doing it. We have done it. What will happen? We will first 3 years we will give the project for the construction and all. After 3 years, suppose some certain portion of the project you are going to you already sold it or you are going to sell, that portion, whatever receipt of that, that will come towards liquidating or reducing the loan amount. On that date, whatever the outstanding and the remaining which has been going to be leased out or lease agreements are in place. Depending on the lease discounting, that loan can be the same loan. Remaining amount paid, the same loan can be converted into the lease rent discounting for a longer period, maybe up to 9 years also. Lease rent discounting, we can go up to 9-10 years. And this has been done. This has been done in the past also, and this is being done also.
That's actually a very good suggestion. We were thinking, assuming it only for commercial projects, we were applying this particular formula. I think this can be applied for residential. Though the rental amount that is inflows that are coming will be substantially very less. But still, if it can be accommodated, at least at a project initiation level, it's a very good thing. Moving on to the next important aspect of project funding. SBI Cap has got one in this under Swami Fund. There is one category of funding for the promoters are not being taken as the important aspect. The projects are given more importance. So, in fact, I would like Rajat Goel ji to throw some light on that.
For Swami, we are focused on a project. We look at how the project can get delivered and the ultimate home buyers can get their houses. We pay limited reliance or limited view on the promoters' history, how they have been. Not that we completely ignore it, but we play limited reliance, get bothered by it. We are very forward-looking. We believe that bygones are bygones. So with that whole approach and attitude, we'll look at project-based funding. As long as we believe that a project can get complete, the homes can get delivered, and people can, and we can get our money back, we are ready to fund that project. There are situations, and I'll not say that there are situations wherein we are unable to detach or completely de-link the promoter's past history with the project's future. So some of those projects becomes a challenge, and there the whole promoter-based concept also comes into play. But they are very far and few. In most, and I'll say almost 98% of the projects that we want to do or we've done are all forward-looking. A good part, in last 3 years is that the industry per se has evolved. The promoters have, whoever had the challenges in past, have tried to iron them out, have come out more cleaner and try to position their project and with the whole intent of delivering it. So that has, as an industry, as a whole, is coming out in that tone. So which is great. The way I'll see this as slightly different is that what we are doing at Swami may not be true for a traditional lending situation, because we do play a reliance, whether we like it or not, a reliance on a promoter background, a promoter's intent, a promoter's whole, which we typically call it as a promoter-based funding. So which will continue to happen, I'm assuming. A fund like ours, which is on stalled projects, or which I was saying in the start of my conversation, was that it's a theme-based, so the theme is stalled here. So people like us, a theme-based project, a theme-based funding, a stalled funding project, we'll look at a forward base, and we have to. That's our objective here, and we want to be true to our theme. So that's what we have.
Now, just a continuation to this question. One straight yes or no can suffice.
Sure.
Would you prefer promoter-based funding or project-based funding?
So we do project-based funding.
You prefer project-based
Yes.
funding. I think that opens up a lot of scope for even builders also, because new set of partnerships can happen, new set of landowner and builder partnership can happen, new set of investor and builder partnerships can happen, and there will not be any kind of whatever the previous bad exposures are there, that need not be considered.
Which is true. So in many of our projects, we have taken an attempt to dealing the promoters with the project in the interest of the project, and promoters do understand that it is in their interest, in the larger interest, to save their own brand equity. They have detached themselves from the project. We have got a DM partner in place to complete the project. And for a home buyer, they get their houses, their whole, the bad history gets settled faster.
Absolutely, because ultimately projects pay back the money, promoters don't have to.
That's a tough statement to make.
With this, with the paucity of time and blinking on time's up note there, we will take two questions. For the other questions, we have some feedback forms in front of you. You please fill up those forms and give it to us, which is very important. We want to analyze everything. We want to make sure that all of these comments are read, and we want to understand all of your comments there. Just for the ceremonial purpose, I will take 2 questions. First one. Can somebody give a mic, please? Pauline? Please.
But there is no room for commercial projects, which is also contributing a lot to economy. And
Can you please come again?
there is a lot of answers or solutions for stalled or stressed residential projects, but there is no answers for commercial projects, which are at a good location, strategically very far in terms of capital value, it is good, but nobody is answering those projects. So any solutions we can, as an industry, can try, or any solution bankers can provide, or anything we can deliberate on it. A lot of such opportunities are in market, but absolutely there is a dead asset lying in the economy, which is really a worrisome part actually. As we are more discussing it as an industry, this is a question to all of us actually.
See, in my opinion, there are no commercial projects which are on stalled situation because you are not factoring in the sales at all. So that is the main reason why we want a new product where we don't want to consider the sales inflows. I think that's a very good observation. Maybe we can note it in our research also. Thank you. The second question? I think we will take the feedback forms. Please feel free to write your feedback and suggestions for this panel and the next one. I am Satish Kumar signing off for that. Thank you.
Thank you so much, gentlemen, for the lovely panel discussion. Can we have a huge round of applause for our panelists and our moderator? And like rightly said by Mr. Satish, we have a feedback form right in front of you on each table. I would request you to kindly fill it, and they will be collected later by our representatives. So go ahead and fill out any questions that you have.